Hello and welcome to a new video. In this lesson, I'm going to share with you guys three factors, three conditions that if you implement them on your next series of trades, they will make them high probable trades. These three factors took me almost 10 months as an ICT student to realize them and fully understand them. And when I started focusing on them, everything clicked for me. And I'm going to share them with you guys for free. So please hit that like button and subscribe to my channel. That would motivate me to do more videos like this. So starting with the first factor that's going to make your next series of trades high probable, which is having a clear target. Now, what do I mean by a clear target? A target is an objective. An objective, for example, a higher time frame objective that the market wants to go towards it. So you need to have something to aim for. You need to be a sniper instead of a machine gun, taking random trades and hoping for one of them to hit a target. For example, you take a long position. You need to know the target you are aiming for. If you don't have a target, then you don't have a trade. So the target is the why. Why price should go that way? What is it there on the upside that is making price gravitate towards it? And I'm saying this because a lot of ICT traders out there are taking positions to go long or short based entirely on an entry pattern. So they have spotted on the lower time frames, for example, a displacement, a market structure shift, a fair value gap, and a breaker, maybe an order block, or all the three of them in one setup. So they think that is high probable trades and disregard completely the target. So they have that perfect entry setup, but they don't have a target to aim for. And you need to understand something, guys, without a target or an objective. And you need to understand something, guys, without a target or an objective, every single one of those entry patterns will fail to hold price. Because price doesn't go up just because there is a 5-minute fair value gap or an order block or a breaker. It goes up because there is an objective it wants to reach. And then those entry patterns will start to hold price. So the target is the why and the PD arrays are the how. So when you have a target in mind, you can predict for the formation of those entry patterns. So you are not basing your entire trade idea on the fact that you have an entry pattern, but you are framing the idea because you have a clear target in mind, and the entry pattern is the least important. So if you don't have the why, then there is no how. So you need to start focusing on finding the drawn liquidity, which is the target, and stop looking for the perfect entry pattern. Now, what are the types of targets? What do you want to aim for? So the target can be either premium low resistance liquidity, which is filled swings or equal highs. You can go back and check my previous videos when I discussed low resistance and high resistance liquidity in details. So you want to target filled swings on premium. So if you are going, for example, on a long position, you want to target filled swings. Those filled swings represent liquidity. So there's liquidity above each one of them, and you want to aim for premium levels. You want to take long on discount and you want to aim for premium. Or it can be a premium imbalance or a fair value gap, so the same thing. So these are the types of targets you want to aim for, either low resistance liquidity, filled swings, or an imbalance. So price will either seek for liquidity or balance an imbalance. So the next time you take a trade, zoom out and see if you have a target. And if you are guys currently searching for a reliable platform to start your trading journey, I highly recommend Trado. It's a new funding firm with huge potentials, offering some of the best conditions any trader could ask for. Firstly, they provide unlimited time limits on their challenges, allowing you to trade at your own pace and without any unnecessary pressure. Trado also has an exclusive trade locker platform, provides an optimal trading environment equipped with advanced chart analysis tools powered by TradingView, and has seamless execution capabilities. Moreover, they offer the freedom to trade with your preferred style and strategy, as they have no consistency restrictions. This means you can implement any trading approach that suits your preferences. One standout feature of Trado is their exceptional customer support, available around the clock 24/7. So whether you have questions, concerns, or require assistance, their dedicated support team is always there to provide prompt and reliable guidance. So if you are ready to take a chance and give Trado a try, be sure to click on the link provided in the video description below. It's a golden opportunity, guys, to kickstart your trading career with a trusted and promising prop firm. The next factor is a rate on liquidity. As the saying goes, no rate, no trade. Now, what do we mean by that? So if you want to take a long position, you need to make sure that the market cleared sell-side liquidity. And if you want to take a short position, then you need to see buy-side liquidity has been cleared. And the reason and the logic behind this is the market is creating high resistance liquidity on the opposing side. So remember, from the first factor, you want to see either a fair value gap or low resistance liquidity as a target. So let's focus on low resistance liquidity, which is fill swings. So let's say you want to take a buy position. So after the market took the liquidity from the sell side, so the liquidity below you, there is a good chance that the market won't go back to take more sell side liquidity because it already did. And it has clear targets on the buy side in the form of fill swings. So it has a clear target on the buy side of the curve, and it has already took sell side liquidity. So taking a long setup while there is liquidity below you is risky, and the market can easily return to take it and reverse to your TP after it hit your stop loss, and it is more painful than hitting your stop loss and keeps going down. So the next time you take a trade, make sure liquidity has been cleared below you if you want to take a long setup, and liquidity has been cleared above you if you want to take a short setup. And the third factor, which is the most important one, time. So ICT teaches time and price, and there is a good reason why you put time first. Time is a complicated subject, and it is more than just kill zones. But as starting ICT student, taking all your trades within the kill zone will make them higher probable than taking outside those specific times. And here you can see the kill zone times. You can save this. Now, if you would open the weekly chart, and for example, we have the USD. So this is the Australian dollar against the US dollar, the weekly chart. And here we're going to talk about some concept called open, high, low, and close, and open, low, high, and close. Now, what do we mean by that? And for the sake of simplicity, let's take bullish candles only. So each bullish candle, you can see that there is an open, a wick, all right, and then an expansion to the upside. So the open, the low, the high, and the close, you can see here also. So the open, the low, a fake move to the downside, and then expansion higher. And then you can see a close just below this high right here. Each candle, each bullish candle is the same. Now, what does that have to do with time? Let's zoom in a bit. Let's go to the daily chart. So you can see, based on what I have shared with you guys on the concept of open, low, high, and close, you can expect the beginning of the week, so the first 2 days or 3 days, to be bearish days. So we are timing the market. We can expect the first 2 days or 3 days to be bearish in case you are, of course, looking for an expansion higher. So you have already a weekly bias of going long. So you expect the first 2 days or 3 days to be bearish and then an expansion higher. Now, this fake move right here, this fake move has an objective. It's not just a move. It has to do something. And in this context right here, it took liquidity from this. So it is preventing buyers to participate in this move right here. So anyone who bought here and have their stop losses here is going to be stopped out here and then expanding higher, all right? This fake move right here can do only two things. It can either seek for liquidity right here, so it can either take liquidity or balance an imbalance, all right? Based on this context right here, it took liquidity to prevent these buyers right here from participating on this move right here. So you can see that we are implementing time in our trades. And guys, this is the weekly chart, and you can apply this concept on each candle. So if you go to, for example, the daily chart, and let's take this candle right here. So you can see that there is a fake move to the downside and then an expansion higher. All right, so at the beginning of the day, you can expect a fake move to the downside to take either liquidity or balance and imbalance, and then you want to take longs. So how we are timing the market? By expecting the first hours of the day to be bearish in case we have a bullish bias, and or can be bullish in case we have bearish bias. So let's zoom in on the 15-minute chart on that bullish daily candle. So you can see that after midnight, and this is a true opening day, all right? On your chart, you will find that it is 5 p.m., but the true opening day is midnight, New York time. So you can see that there is a fake move right here. You can see that there is a fake move. So from midnight to all the way to, so the 4-hour candle was bearish, all right? So the first 4 hours of that daily was bearish, which is a fake move. It is also called a jitter swing to do what? Balance this imbalance right here and then expand it higher. So you are timing the market. You know that after midnight, if you have a bullish bias, you can expect and anticipate a fake move to the downside. So guys, this is my point of view of time, and it is how I use it on my favor. And this is only the tip of the iceberg. There are more to time than you can imagine. So here you got it. 3 conditions, 3 factors that if you add them to your next trade, you're gonna have a high probable trade. Guys, if you enjoy the content, please leave a like. If you have any questions, leave a comment or DM me on my Twitter account. Happy trading and good luck.